Good morning, everyone. My name is Gerard Vecchio, and I'm a Senior Vice President at MarshBerry. Throughout this week, we have had a study called The Good, the Bad, and the Ugly, where we have talked about, among other things, why the insurance and brokerage industry is much better positioned than some other industries to weather this current crisis. We've talked about, however, the risks involved in the industry, and as you've seen, we've also talked about putting your head in the sand is not necessarily a good way to approach this crisis. Today, we're going to do something a little bit differently. I have with me here today David Paul, who's a partner at ALIRT Research. ALIRT Research covers both the property casualty and the life insurance industry, the carriers, specifically doing a fair amount of financial and operational analysis using statutory data and other publicly available data. Today, what we thought we'd talk about is how this is affecting the carriers, and I have a couple of specific questions for David to respond to, specifically with regard to what happens if carriers start to assume risks that may or may not be originally intended in their policies and or delay the payment of premium payments for some period of time. So with that, I'd like David, if you want to give just a brief introduction, please do, and then we'll get to the questions.
Sure. Yes, I am a partner at ALIRT Insurance Research. As Gerard said, we specialize in analyzing the financial strength of the insurance industry across three models: property casualty, obviously, medical health, and a lot of life products. We've been at this, my two partners and I, for close to 30 years, 20 years on our own. And obviously, we're watching this current environment very closely. They always say that credit analysts are popular in times of woe, which is unfortunate. Unfortunate, I guess, for us, but unfortunate for everybody else. So this is kind of our fourth crisis that we've been through since we've been in the business for 30 years. So we've seen a lot of we have a lot of experience seeing how these types of capital market and economic downturns impact insurance companies. So, we're here to help out however we can.
Thank you, David. Appreciate that. So why don't we get to our first question? And this really involves what happens or carriers' responses to some of their existing customers. What we've learned over time is that history has taught us that insurance carriers' existing customers tend to have lower loss ratios than new business. Again, especially those accounts where the longevity at a single carrier may be 3 or more years. So knowing this as the backdrop, David, is it possible that we witness carriers paying claims for which they may or may not be contractually obligated to do so, just in order to retain those clients that have a long-term demonstrated history of profitability?
No, it's a good question. I think it really depends on the magnitude of a potential loss. I think you're right, and we have heard this certainly over time from our many broker clients that existing clients, especially long-term ones, are very profitable, and that insurers certainly like to maintain these relationships. That said, I don't think an insurer can sacrifice its own income statement and balance sheet for substantial losses. You think of maybe some of the business insurance that we've heard a lot about, potential business insurance losses being covered, for which they really didn't get any premium. If this is a BOP, even you've collected very little premium for that element of the BOP. And, to take a large loss could erase, 10 to 15 to 20 years of potential profitability if this thing goes on long enough. So I do think that it's going to be on a case-by-case basis. Again, I'm an analyst. I'm not a frontline producer, but I've been talking to a lot of our agents, and they basically have been saying that they've been spending a lot of time talking, of course, with their clients on a one-off basis and also their insurers on a one-off basis. And I think this is the type of environment where brokers, as you know, really earn their keep, right? They're there as advocates for the clients and acting as intermediaries. So I do think it's going to be on a case-by-case basis. And that said, I don't think insurers necessarily want to set a precedent for covering things that they don't get paid for. So I don't think there's a clear-cut answer. I think it can happen on the margin, but I think they're going to have to, the insurers are going to have to be very careful about it.
So on balance, what I hear you saying is that there's maybe an equal amount of risk that certain long-term accounts are lost because the losses are such that the insurers decide ultimately not to pay, and on the argument that they weren't contemplated or covered on the one hand, versus those that may be of the losses may be of a less great magnitude, where in fact by paying those claims there might actually be greater retention of that customer. And your thoughts on how that might positively, negatively, or neutrally affect insurance broker, specifically their commissions that would result from those premium payments or that claims coverage.
Well, I mean, if you're talking about commissions, I guess maybe you're talking about contingency. Well, there's obviously regular commissions, contingent commissions. Quite honestly, on the contingent commission side, and I just had a discussion with someone about this yesterday. Contingents obviously generally will have some profitability element in them. There are or some revenue element in them as well in terms of revenue growth. I think with this current environment, at least for the next several quarters, unless this thing wraps up very quickly, both the top lines and the bottom lines of insurer income statements are going to be hit. I think contingents are going to be hit as well, regardless of whether, the first question had about the retention of certain clients by covering things. So I think that it's going to be a tough revenue environment for brokers as well. I think that's just across the board. And quite honestly, everyone I've spoken to of our clients has said that they're kind of expecting this. Again, whether insureds decide that an insurer is being unfair to them, this is a very unique situation. There's been plenty of information out there about why business interruption probably will not be covered because it was an excluded peril, if you will. I don't know that a lot of insureds will, leave an insurer just because in this extraordinary circumstance they didn't cover something that was never intended to be covered in the first place. I think the other thing that's happening is the federal government has stepped in. I know we may talk a little bit about this later, and has put in place backstops so that the need for insurers to backstop some of this stuff is less than it might have been without a federal backstop. So I do think there's help coming to businesses to help offset business interruption so they don't necessarily have to go to the insurers and ask for things that quite honestly don't seem fair.
Well, just to pick up on that last point you're making with regard to a backstop, if in fact what ends up happening here is that the government puts in a fund not dissimilar to when TRIA was put in place after the 9/11 terrorist attacks, do you think that actually might benefit insurance brokers, that they can now sell this product and get commissions? Or how do you think that would there be an effect on the insurance brokerage community one way or the other?
Well, certainly I think there is a benefit. Obviously, the way to expand premium is obviously in a good environment like we were having up to a month ago. You expand exposure units. That's certainly a way to grow premium. Rate is obviously, we've been seeing rate over the last a year to 18 months as a way to grow premium. But new risk also, or new coverage, like something like cyber, is a way to grow the pie of potential exposures as well. I think I was reading something from Guy Carpenter saying that there's about a 60% uptake on the TRIA coverage over time on average. And I certainly could see something like TRIA being put into effect for pandemics going forward. I think it makes a ton of sense. It's very similar. There's just, with the types of losses we're taking, upwards of, I've heard figures 350 to 400 billion for business interruption. It's just something that the U.S. property and casualty insurance industry cannot cover. They just don't have enough surplus to cover those types of losses. But I think if you can create something like TRIA where insurers have skin in the game, but ultimately have a federal backstop, I think that's a great development, and I do think that it's being looked at now. I do think that this is something that is going to be probably talked about in greater depth as we go forward. And quite honestly, very few people, I think, were anticipating exactly what a pandemic can do to the economy. Now we know. And I think that insureds of all stripes will really think very hard about paying some additional money. I think positively we'll think about paying additional money for this type of coverage. So I think right now with the CARES Act, that's more of a build a liquidity bridge, get to the other side. I know that I was just reading today NCOIL and the American Property Casualty Insurance Association the last couple of days have been trying to also build a supplementary and additional fund to help, again, as a liquidity bridge. Those things are temporary in nature, but I think what you're talking about more long-term could be quite attractive to this industry in terms of additional revenue.
Thank you, David. Appreciate that. And we'll have we have time for one last question, and it really revolves around the moratorium, or delay, I should say, in premium payments that many of the insurers are granting their insureds in this time of crisis without actually canceling coverage. So, David, what do you think is the likelihood that this delay of premium payments, where a carrier might actually pay claims and then never actually receive the associated premiums because small businesses, sole proprietorships end up going out of business before they have the opportunity to actually pay these claims? Do you think that such a scenario could evolve over the next 3, 6, 9 months, depending on how long this crisis lasts? And what could be the effect on commissions paid or not paid to the insurance brokerage community?
Yeah, I mean, this is a very trying issue. We obviously released a paper on this earlier this week, which I've actually updated twice because more and more insurance departments, especially the regulatory bodies of the state insurance departments, are stepping in and putting moratoria in place for extension of premium payments, et cetera. So this is a real issue. I know the CIAB, if folks want to see, have something on their website as well that has a running update on what the regulators are doing. The action has really been driven at the regulatory level. Obviously, some of the big personal lines carriers came out earlier than others to say that they were allowing some forbearance on the payment of premiums. But it's really, this issue, I think, has really been driven by the state insurance departments, either suggesting with a lot of language that was more suggestive of what they hope happens, to some insurance departments saying categorically you cannot cancel premiums. So, folks who are interested, certainly through you guys, can get our piece on this. But this is definitely, it's going to be a big issue. We look at it from the perspective of what happens to an insurer's financials if they pay a claim and don't ultimately receive the premium that was supposed to be backing the policy that that claim was paid on. And that can have repercussions for the profitability of property casualty insurers. I won't get into the details of how they account for that, but we're going to be watching that very closely. Obviously, at the point of cancellation, if a policy doesn't go a full term, if someone goes out of business, then any premiums paid for the full year on that would be clawed back by insurers. I think there's a bigger issue here, and I really became more aware of it yesterday, talking to a broker client who seemed very harried, as I'm sure all of your broker clients are, but basically saying that for commercial policies, 85%, in his view, he was guessing, are broker billed or agency billed, if you will. So it's not direct bill to the insurer, it's not premium financed. And in those cases, he said, on a case-by-case basis, the agency will have a legal contract with the insurer, which basically details whose responsibility it is to pass through premium payments. The reason this is important, he said, is the agents could be on the hook to pay these premiums if the insured doesn't. So let me just walk you through this. So in the case of there was forbearance for say 2 or 3 months, a claim was paid. The premium, after the claim was paid, the client either says, I'm not going to pay my premium because I don't have cash flow, or I'm out of business. Well, for that period of time that the premiums weren't collected, the agency could be held liable to pay those claims up to the insurer. So this is a massive issue, obviously, and this is something obviously I'm sure your broker clients and agent clients are looking at. They probably don't have the cash flow to obviously meet these payments as well. So there's going to be a lot of discussion, I think, between the agents and the agencies and the insurers about how to handle this issue. Obviously, if no claim was paid, it's kind of, it's a moot point. It doesn't really matter, though I guess legally they could say, hey, we kept it in force, so, these payments should come through. But yeah, this is a big issue. Obviously, this might give a fill up to premium financing or doing more direct billing so you don't run into these issues. But I think it's going to be something that I know everyone's watching it. We're watching it closely as well.
David, I thank you very much. That particularly that last point of yours on the potential liability of agency bill is quite is quite fascinating and somewhat scary. And I think what we'll see over time is that there'll be more discussion on that. So thank you. So let me again thank David Paul, partner at ALIRT Research, for taking the time today. David, we always appreciate your insights. So thank you very, very much, and have a great day, everybody. If anybody wants to find out some more information on this, they can go to marshberry.com /subscribe. Everyone, please have a nice day, and thank you.